Have you ever wondered why some investors panic sell during market dips, while others stay calm? In this video, we'll explore how to build a portfolio that stands strong against market fluctuations. You'll learn the key principles of diversification, risk tolerance, and long-term thinking. By the end, you'll have the tools to create a resilient investment strategy that keeps your emotions in check. Have you ever found yourself staring at your investment portfolio, feeling that familiar knot of anxiety in your stomach? You're not alone. Picture this. It's a beautiful Tuesday morning, and you check your stocks only to see a sudden drop. Your heart races, and before you know it, you're hitting that sell button, convinced you've just saved yourself from disaster. But what if I told you there's a way to build a portfolio that keeps you calm, even when the market gets rocky? Imagine investing with confidence, knowing you won't panic sell at the first sign of trouble. Today, we're diving into how to create a resilient portfolio that stands the test of time. So, if you're ready to take control of your financial future and build a portfolio that brings you peace of mind, hit that like button, share this video with your friends, and don't forget to subscribe to Chill Finance for Real Life. Let's get started. Before we dive in, please remember that this video is for educational purposes only. It's not financial, legal, or tax advice. Always do your own research and consider seeking professional advice tailored to your situation. Building a portfolio is a personal journey, and what works for one may not work for another. Now, let's get started on how to build a portfolio you won't panic sell. Imagine this. You've spent time crafting your investment strategy, but when the market dips, you feel that familiar knot in your stomach. Panic selling is a common reaction, but it can be avoided with a solid portfolio. So, how do you create a portfolio that stands the test of time? First, let's talk about diversification. This means spreading your investments across different asset classes, like stocks, bonds, and real estate. The goal is to reduce risk. Think of it this way: if one investment falters, others may still perform well. This balance can help you avoid that knee-jerk reaction to sell when the market fluctuates. Next, consider your risk tolerance. This is how much risk you're comfortable taking. Are you someone who prefers stability, or are you okay with the ups and downs? Understanding your risk tolerance helps in selecting the right mix of investments. Now, let's touch on the importance of setting long-term goals. Ask yourself, what are you investing for? Retirement, a home, or maybe travel? Having clear goals can keep you focused and less likely to react to short-term market movements. And here's a quick recap. Diversify your investments, know your risk tolerance, and set long-term goals. These strategies can help you build a portfolio that aligns with your financial journey. Lastly, remember that investing is not a sprint, it's a marathon. Markets will have their highs and lows, but a well-thought-out portfolio can help you stay the course. Alright, now let's zoom out and think about the bigger picture. Investing isn't just about numbers, it's about your life and your future. Take your time, do your research, and don't hesitate to seek help if you need it. Your financial well-being is worth the effort. Have you ever felt that gut-wrenching panic when you see your investments drop? It's like watching your favorite roller coaster plunge down, heart racing, breath held. But what if I told you there's a way to build a portfolio that keeps you calm, even when the market takes those wild turns? Today, we're diving into how to construct a portfolio you won't panic sell. The key lies in understanding your investments, having a plan, and creating a cushion for those inevitable market fluctuations. Let's take a closer look at how to do this in a way that feels manageable and even empowering. First, consider the concept of risk tolerance. This is simply how much market volatility you can handle without losing your cool. Think of it like choosing a hiking trail. Some people are comfortable with steep, rocky paths, while others prefer a nice, flat route. Knowing your comfort level helps you pick the right investments. Now, let's talk about diversification. Picture a fruit salad. If you only have bananas, it might get boring, and if they go bad, you're left with nothing. But mix in apples, berries, and oranges, and you've got a delicious variety that can withstand the test of time. In finance, diversification means spreading your investments across different types of assets, stocks, bonds, real estate, and more. This way, if one area takes a hit, the others can help balance it out. So, how do we build this diversified portfolio? A common approach is to allocate your investments based on your age and risk tolerance. For example, if you're young and have a higher risk tolerance, you might consider a mix of 70% stocks and 30% bonds. This assumes a growth rate of around 7% for stocks over the long term, which is a reasonable historical average. Let's do a quick calculation. If you invest $1,000 in stocks expecting a 7% annual return, after 10 years, you could see that investment grow to about $1,920. That's a nice increase, right? But remember, this is just an example, and actual returns can vary. Now, if you're more conservative and prefer less risk, you might flip that ratio to 30% stocks and 70% bonds. In that case, your investment in stocks would grow to around $650 after 10 years, while your bonds would provide more stability. The key here is that both strategies have their merits. It's about finding what suits you best. Another crucial element is setting clear investment goals. Think of it like planning a road trip. You wouldn't just drive aimlessly, you'd have a destination and a route in mind. Are you investing for retirement, a home, or maybe a dream vacation? Knowing your goals helps you stay focused and less likely to react impulsively when the market dips. And let's not forget about the power of regular contributions. Just like watering a plant, nurturing your investments consistently can lead to growth over time. Even setting aside a small amount each month can make a significant difference. For instance, if you contribute $100 every month to your investment account, at a 7% return, you could accumulate over $27,000 in 10 years. That's the magic of compounding interest working in your favor. At this point, you might be wondering, how do I avoid panic selling when markets are down? The answer lies in having a solid plan and sticking to it. When you feel that urge to sell, pause and reflect. Ask yourself, is this decision based on fear, or is it aligned with my long-term goals? So, as we wrap up, remember that building a portfolio you won't panic sell is about understanding your risk tolerance, diversifying your investments, setting clear goals, and making consistent contributions. Take a moment to think about your own investment strategy. Are there areas you can improve or adjust? Share your thoughts in the comments below. Let's keep this conversation going, and together, we can navigate the ups and downs of investing with confidence. When it comes to investing, one of the biggest fears people face is the urge to panic sell during market downturns. The key to overcoming that fear lies in building a portfolio that you trust and understand. So, let's talk about how to create a portfolio that you won't feel the need to abandon when the going gets tough. First, we need to establish a baseline for our calculations. We're going to use a consistent interest rate of 7%. Why 7%? Historically, the stock market has returned about this rate over the long term, after adjusting for inflation. It's a reasonable expectation for a diversified portfolio over many years. Now, let's imagine you want to build a portfolio with an initial investment of $1,000. If you were to leave that money invested and let it grow at 7% annually, how much would it be worth in 10 years? To find that out, we use the formula for compound interest, which is the initial amount multiplied by 1 plus the interest rate raised to the number of years. So, we take $1,000, multiply it by 1.07, and raise that to the power of 10. 1,000 multiplied by 1.07 to the power of 10 equals approximately $1,924. That's a nice increase, right? But what if you want to take a more active approach and add money to your investment each year? Let's say you decide to contribute an additional $100 each year. We'll calculate how much you would have after 10 years with those contributions. Starting with the initial investment of $1,000, we'll still use the same interest rate of 7%. For the first year, you invest $1,000, and at the end of the year, it grows to $1,070. Then, you add your $100. Now you have $1,170 at the start of year 2. This process continues. Each year, your total investment grows by 7%, and then you add another $100. After 10 years, that initial $1,000 plus the additional contributions would grow to approximately $2,740. That's a significant increase, and it shows how consistent contributions can really add up over time. Now, let's switch gears for a moment. Imagine you're in a coffee shop, and you overhear two friends talking about their investments. One is panicking about a recent market dip, while the other is calm, sipping their coffee. The calm friend has built their portfolio with a long-term perspective in mind. They know that markets go up and down, but they trust in the growth of their investments over time. This brings us to the importance of diversification. If you invest all your money in just one stock or one sector, you're exposing yourself to significant risk. But if you spread your investments across different asset classes, like stocks, bonds, and real estate, you're less likely to panic during downturns. Let's say you decide to allocate your $1,000 into 3 different areas: $400 in stocks, $300 in bonds, and $300 in real estate. If we assume that stocks grow at 7%, bonds at 4%, and real estate at 6%, we can calculate how each would perform after 10 years. For stocks, $400 growing at 7% would be approximately $802. For bonds, $300 at 4% would grow to about $447. And for real estate, $300 at 6% would grow to about $536. When you add those amounts together, you'd have about $1,785. That's not just about the numbers, it's about confidence. When you know your investments are spread out, you're less likely to panic sell. Now, let's take a moment to reflect. How do you feel about your current investment strategy? Are you comfortable with it? Building a portfolio isn't just about the math, it's also about your mindset. As we wrap up, remember that investing is a long-term game. If you can create a portfolio that aligns with your goals and risk tolerance, you're less likely to make impulsive decisions when markets fluctuate. So, next time you hear market news that makes your heart race, take a deep breath. Trust in the plan you've created and let your investments grow. If you found this discussion helpful, I'd love to hear your thoughts. What strategies do you use to stay calm during market turbulence? Share in the comments below. Investing is a journey, and it's best traveled with a clear mind and a solid plan. When Sarah turned 30, she found herself at a crossroads. After years of living paycheck to paycheck, she finally had some savings. Her friends often talked about investing, but Sarah felt overwhelmed. One day, she decided to take control. She set a goal of saving $1,000 for her first investment. With that amount, she researched and learned about a diversified portfolio. She chose a mix of stocks and bonds, aiming for an average annual return of 7%. Why 7%? It's a common historical average for stock market returns, factoring in growth over time. After a year, Sarah was excited to see her investment grow to $1,070. But when the market dipped, panic set in. She thought about selling everything. However, she remembered her goal and her research. Instead of reacting, she held on, knowing that the market fluctuates. Fast forward 5 years, and her portfolio grew to around $1,400. By sticking to her plan, she learned not to panic sell. Sarah realized that investing is a long game, and patience pays off. Now, let's consider another example. Meet Jason, a 45-year-old teacher who wanted to secure his family's future. He started investing with a modest $5,000. He focused on index funds, which are collections of stocks that mimic market performance. With that initial investment, he anticipated a 7% return. After 5 years, his investment would grow to about $7,000. But when the market took a downturn, he felt the urge to sell. Instead, Jason took a moment to reflect. What's the long-term plan? He asked himself. He remembered that investing isn't just about short-term gains. By holding on, his portfolio eventually recovered and surpassed $8,000. Now, Let's switch gears to a different perspective. Emma, a 25-year-old freelancer, wanted to build wealth. She started with $2,000, focusing on a mix of tech stocks and bonds. Emma faced a significant market drop early on. She thought, should I sell and cut my losses? Instead, she decided to diversify further. By adding different sectors, she protected herself from volatility. Over time, her portfolio grew to $3,500. What's the lesson here? Diversification can help you weather the storm. Lastly, let's meet David, a retiree who wanted to ensure his savings lasted. With $70,000 saved, he focused on a balanced portfolio of stocks and bonds, aiming for that steady 7% growth. When market fluctuations occurred, David felt anxious, but he had a plan. He remembered the importance of staying invested, especially since he didn't need to withdraw immediately. Over the next decade, he watched his portfolio grow significantly, allowing him to enjoy his retirement fully. These stories illustrate that building a portfolio you won't panic sell takes patience, planning, and sometimes a little courage. What's your investment strategy? Have you ever felt that sinking feeling when the market dips? Let's explore how to build a portfolio that keeps you calm, even in turbulent times. First, start with a clear understanding of your goals. Ask yourself, what are you investing for? A retirement, B, a home, C, education, or D, something else. Knowing your purpose helps you choose the right assets. A portfolio aligned with your goals is less likely to provoke panic. Next, diversify your investments. This means spreading your money across different asset types, like stocks, bonds, and real estate. Imagine if you only owned one type of stock and it fell. With diversity, a loss in one area can be balanced by gains in another. It's like not putting all your eggs in one basket. Third, focus on quality over quantity. Invest in companies or funds with solid fundamentals. Look for those with a history of growth, strong management, and a competitive edge. When you believe in what you own, it's easier to hold on during downturns. Alright, now let's zoom out and talk about risk tolerance. What's your comfort level with market fluctuations? High risk, B, moderate, or C, low. Understanding your risk tolerance helps you create a portfolio that feels right. If you know you can handle some volatility, you're less likely to panic when markets dip. Also, consider a long-term perspective. Investing is not a sprint, it's a marathon. Historically, markets have trended upwards over time, despite short-term fluctuations. If you plan to invest for 10 years or more, daily ups and downs become less significant. Another key lesson is to regularly review your portfolio. This doesn't mean checking it every day, but setting a schedule, like quarterly or biannually, to assess your investments. This allows you to make informed adjustments without emotional reactions. Finally, remember to stay informed but not overwhelmed. Follow market trends and news, but avoid sensational headlines that can trigger fear. Take a moment to breathe. When you're calm and educated, you're less likely to make rash decisions. So, what strategies will you implement to build a portfolio you won't panic sell? Share your thoughts in the comments below. Have you ever found yourself staring at your investment portfolio, heart racing, wondering if you should sell everything? You're not alone. Many people panic sell during market downturns, often leading to regret later. But what if I told you that there's a way to build a portfolio that keeps you calm, even when the market gets shaky? Let's talk about some common objections you might have. First, you might think, I need to act fast when the market drops. Sure, it feels that way, but remember, investing is a long game. When you build a diversified portfolio, meaning you spread your investments across different assets, you reduce the risk of any single investment dragging you down. You might also say, but what if I lose money? It's natural to worry about losses. However, consider this. If you invest regularly over time, you're more likely to benefit from something called dollar cost averaging. This means you buy more shares when prices are low and fewer when they're high, balancing out your costs over time. Now, let's address a common fear, What if I miss out on quick gains? It's tempting to chase after hot stocks, but remember, those quick wins can be just as quickly lost. Focus on your long-term goals instead. So, what's holding you back? Is it fear? Uncertainty? Take a moment to reflect. Building a resilient portfolio takes patience and planning. Before we wrap up, I want to hear from you. What strategies have you tried to stay calm during market fluctuations? Share your thoughts in the comments below. Alright, now let's zoom out and look at how you can take these ideas and apply them to your own financial journey. Have you ever found yourself staring at your portfolio, heart racing, wondering if you should sell everything? Let's talk about how to build a portfolio you won't panic sell. First, start with a solid foundation. Diversification is key. This means spreading your investments across different asset classes, like stocks, bonds, and real estate. Imagine you have a fruit basket. If you only have apples and one of them goes bad, your basket is in trouble. But if you have apples, oranges, and bananas, you're much safer. Next, consider your risk tolerance. Ask yourself, how much risk can you handle without losing sleep? If you're someone who checks their investments daily, you might want a more conservative approach. On the other hand, if you can handle the ups and downs, you might lean towards more aggressive options. Now, let's talk about time horizon. How long do you plan to invest? If you're investing for retirement in 20 or 30 years, you can afford to ride out market fluctuations. Historically, markets tend to rise over long periods, even if they dip in the short term. Alright, now let's zoom out. Regularly review your portfolio, but resist the urge to react to every market shift. Set a schedule, maybe quarterly or biannually, to reassess your strategy. This helps you stay focused on long-term goals instead of short-term noise. Finally, remember to stay informed but not overwhelmed. Read, watch, and learn about the market, but don't let fear dictate your decisions. So, what's your strategy to avoid panic selling? Share your thoughts in the comments below. And if you found this helpful, don't forget to like and subscribe for more chill finance tips. As we wrap up, remember that building a portfolio you won't panic sell involves a few key strategies. Diversify your investments to spread risk. Focus on your long-term goals and stick to them. Regularly review and adjust your portfolio as needed. Keep emergency savings separate to avoid stress during market dips. Educate yourself continuously to boost your confidence. Stay calm and remember, investing is a journey, not a sprint. If you found this video helpful, please like, share, and subscribe for more insights. Your finances deserve a chill approach. Until next time, keep your cool and stay financially savvy. And don't miss our next video, where we'll explore the power of compound interest. Trust me, you won't want to miss it.